Greetings and welcome to another edition of the Ad Astra Kansas Money Talks podcast. I'm Joe Blubaugh and joined, as always, by Mark Johnson and Bob Schwartz of Bob Schwartz Financial. They have offices in Victoria and Silver Lake. Thank God, Hayes on the brain. Victoria and Silver Lake, Kansas. And you can find out more about them at bobschwartzfinancial.com. And as we're recording this episode, it is the last week of September of 2025, and we just had a rate cut by the feds. And we thought, what a great opportunity to talk about what that means, because there are ripple effects that happen when the feds have a rate cut. In this particular case, it was 0.25%. Doesn't sound like much, but Mark, that can really have some big impacts on all facets of the economy, including here in Kansas.
Yeah, exactly. And we kind of think that there could possibly be more rates coming. So we wanted to talk about this, kind of get ahead of the game a little bit.
Sounds good. What are some of the kind of big impacts, and we'll drill down a little bit, what are some of those big impacts that we see with a rate cut by the Fed?
Well, for just the overarching, it makes it easier for the banks to borrow money, or cheaper anyway. And usually that cheaper borrowing flows through to the consumer. So that means lower rates, it's easier to borrow, but also maybe a little bit lower returns on your savings, your money markets, your CDs. So better for borrowers, not as good maybe for the savers, the CDs, the fixed interest people in retirement.
So kind of one of those proverbial double-edged swords, so to speak.
Yeah.
So as we talk about borrowing costs, Bob, what are some of the areas where people can save money, kind of the big picture when it comes to borrowing costs?
Well, what have mortgage rates done? You're in the industry. Have they gone down?
They have. They have gone down. And what we tend to see, and for those of you that don't know, I am a real estate agent, what we tend to see with mortgage rates are that the mortgage lenders, the banks, they're looking to the future. So they don't necessarily react to a cut as much as they forecast that cut and adjust rates accordingly. When rates were going up, we saw interest rates, going up in front of the actual rate hikes by the feds. You see the same thing as they're coming down. I would say the bigger impact on mortgage rates wasn't so much from the cut, but as Mark mentioned, they kind of indicated that there could be a couple more cuts in the near future, and I think those played a part. And we are now seeing interest rates for the first time in quite a few years where they're below 6%. We've got some interest rates into the fives.
So 30-year under 6.
30-year fixed. Wow. And it varies. Obviously, it depends on credit scores. VA loans are a little different than conventional loans. But, yeah, we're starting to see some of those rates get under that 6 barrier, so to speak.
And when you say that, I also think we'll see more zero interest rate car, because the industry will take on the cost of that because it's cheaper money for them. And of course, the car manufacturers can issue bonds to do that with, and so they can borrow 2 or 3% cheaper than what we can. Credit card rates, I don't think they're going to fall. Historically they don't. So in terms of borrowing costs, it's going to be a real positive for the housing market and for new housing. If it gets below 5, I think it'll bump very positively the building industry.
Yeah, I tend to agree. When I'll chime in on the real estate market. I've said for quite a while. I mean, as we see right now, you always have some movement because you got people that need to move or retiring or pass away and a family sells a house. So you see some movement, but the real estate market in the big picture is really stuck in a quagmire because people are locked into these 2.5%, 3% interest rates, and they would love to sell their home. They would love to get to a bigger home or upgrade, but with a 7% interest rate that we've had for a while, it's really hard to do. I think that the psychological barrier of getting back in the 5s will help. I do think if we get under 5, and maybe even 5.5, you might really start to see people shake loose as they feel like they can afford a little bit better house, bigger house. So,
and I'm going to go way off here, but why don't they make mortgages transferable?
that's a great question.
Well, I can tell you why.
Well, please.
I can tell you why. Money.
Money, of course.
Money. We're not, yeah. And if they would start doing that, if they would start saying, your loan is transferable, if the person has the credit score that you had, et cetera, your home is transferable. Your mortgage on your home is transferable. Wow.
Yeah, now they are assumable. Now that's a different
Right.
story. A lot of people don't understand assuming loans. We could do a whole episode on real estate. I won't get into it much, but yeah, mortgages are not
But if
transferable.
I assume a loan, what do I have to go through?
Well, you have to go through the same borrowing process. The only thing you assume is the rate. You don't, and what makes assumable loans more difficult is, if somebody has a ton of equity in their home, the most a person can assume
Is the note.
is what the
Yeah.
note is currently worth. So if there's a bunch of equity, which after, 5 years ago where real estate prices went through the roof, a lot of people have a ton of equity in their home, and that really hurts a potential borrower.
I think what we should hit on here is people need to understand that, because most people don't know. So let's say somebody has sold a home and they've got $150,000 cash from that home, and they want to buy this home that has a 2% interest rate, and the home's worth $500,000, but the note's only $350,000.
Right.
People need to understand that loan's assumable.
Right, you
If
just got to
they've
bring
got
that
the-
150,000
if-
cash to the
If
deal.
they've got the down payment. So a new home buyer, first-time home buyer, is probably not going to be there.
Right.
But a lot of people that Mark and I see have sold homes, went and bought and paid 6% for a home loan when they might have been able to assume a note for
Right.
a much better interest rate.
Because they have the liquidity in their savings.
It's
to
crazy
do
that
it.
that's not pushed anywhere by
If
any.
I,
Well-
if I had a 2% note and I was wanting to sell my house, I would, and Joe was going to list it, I would ask him to please put down that my note was assumable
Right.
and available on request.
Yeah, I think, and honestly, with my limited experience with assumable notes, I believe that almost all conventional loans and VA loans and FHA loans are all assumable. They're almost always written in there that way. It's just not pushed very hard, and once again, it probably comes down to money.
Yes.
The banks would prefer somebody take a new note at 6%
Right.
instead of assuming a note
Absolutely.
for 3%.
Absolutely, absolutely. And folks need to understand that, because we all trust, the banks are doing what's right for us, what the best they can do. No, pay attention. And the assumable loans are, and of course, if you're going to buy somebody my age's home, there's probably not any debt on it. There's not a 2% rate.
Yeah.
But in the cities and, with the way we move in this country, there's probably a lot of assumable loans out there that are getting missed.
Yeah. So obviously the whole reason for the Feds dropping those interest rates are they want to spur the economy. They feel like by doing this, as you mentioned, it makes borrowing cheaper. Borrowing cheaper means potentially more investments that companies make, more jobs, more money flowing into the economy. The downside of it, and we're going to talk a little bit about this, is the impact that it could have on especially fixed interest savings and retirement accounts, your CDs, your treasuries, and your money market accounts. Those all get negatively impacted.
Yeah, psychologically too, we've gotten, like the last 4 or 5 years, we're seeing 5%, 4%, on these
People like
CDs.
5%.
Yeah, 5% CD is awesome. I mean, and especially for those people in retirement that are just, they're wanting to see safe money, and all of a sudden that's going to be creeping down under 4, and in the 3s, and even those bank accounts, those money or those high yield savings, or with banks are going to get pushed even further down.
Yeah.
And so people have to psychologically be ready for that and be willing to go and search out better options for their fixed income. If you feel like you're not getting the best rate possible, like for example, if someone's being like, oh, well, rate cut, you can only have 2%. Well, you can still get quite a bit better than that. So, you should be able to do a little research for yourself and make sure you're not getting taken advantage of by your financial institution.
And then the other where we see a lot of cuts and more on the raising of Fed's interest rate by the Feds is to deal with inflation. So while they are hoping to spur the economy with this rate cut, one of the challenges that one of the things they're really going to have to watch at that level is inflation starting to tick up, and that can be a double whammy for a retiree that has fixed income, seeing their interest rates going down, but inflation is eroding away their dollar at a higher rate.
It's a double-edged sword, and the chairman of the Fed, they addressed that the biggest reason was for job creation, was this 0.25% drop. Because we have been seeing a lot of layoffs, not only at the government level, but at the corporate level.
Yeah.
And if we have if you cut too much, Americans spend, and as we spend, we see inflation. And so right now, with all the taxation, nobody's property taxes are going down. Nobody's homeowner's insurance or car insurance is going down.
Medical insurance.
Yeah, health care. Everything's going up. And in a way, and I'll say this as somebody that was an adult in the 70s, it's kind of like the 70s when no pay raises, but we just watched everything explode price-wise. And the government doesn't want that to run away because, as I've said before on the show, inflation is a cancer that goes through our economy to the wealthiest person in this country down to the poorest person. It's a cancer through all of us, and the Fed.
What's kind of scary in my mind at this time is with the rate cuts and all this. What's scary to me is just this morning inflation did tick up again this month. Jobs, there was 2 million less jobs again. And so those were in line with their expectations, so it didn't scare anybody. But still, we're cutting, and you can start seeing now that the Fed board, there's about half and half that people are like, we need to maybe hold steady a little bit, maybe cut one more time, hold steady. And there's some that are like, we need to cut. And when there's a split like that, it makes me a little nervous as someone that's in this position that I'm in. It makes me a little nervous when the Fed's not unified on that.
Yeah. It is what it is, but it's been politicized, and it's never been that way before, and so we're entering into a new time here, and of course, Joe mentioned earlier we're at the end of September. What's happening October 1st, and I'm telling you, it's going to happen.
Yeah,
Yep.
Government shutdowns looming large.
Yeah, I mean, it's going to happen. It's going to happen. Nobody wants it. Nobody wants it to be taken care of. Either side of the aisle, they don't want it taken care of.
Yep.
And we're going to see a lot of fear in. I don't want to buy a house even if interest rates are down because I don't know what's going to happen to my job or just all those types of things that we all need to be aware of and pay attention to.
Yeah. So we've talked a little bit about kind of what's happening with fixed income. Let's talk about other investments when it comes to stocks, bonds, real estate. What kind of an impact can a rate cut have on those investments? Yeah,
usually cutting raises, like stocks usually, push them up.
Doesn't guarantee that.
No, but
generally very positive for the market, equity.
Cheaper borrowing for companies and businesses means money's flowing, and that's, or at least that's what it, people think and believe. So usually that's kind of what happens. The stock market usually tries to predict that, like you talked about kind of with mortgage rates. They kind of price them in coming into the meetings sometimes. But that's a lot of times when they kind of know. You know, you can kind of see ahead of time. Bond prices rise, but their yields fall. And so,
A quick note here,
Yeah.
always hard to understand, but folks, when interest rates drop, bonds go up in value.
yep.
And it's too difficult to explain.
Yeah, but it is. Bonds are, I have a hard time wrapping my head around bonds, but the thing I try to remember, as interest rates fall, new bonds are worth less, so those older bonds that have the higher rates, people are like, ooh, I want that one.
Right.
So I'm willing to pay a little
But
bit more
it's
for it.
priced higher.
Right.
Because the yield's going to be lower.
Right.
And
It's just very.
once you get wrapped around it, it's pretty simple, but you have to understand the clicks of the bond market.
So, and then we've already kind of talked about real estate, and maybe I'll speak to this one. I agree with what you said earlier. I think real estate, as the rates fall, more and more people will be interested in either not being renting anymore and buy their first house, or finally move away from the house that they've been in for a while at those lower interest rates. The price of homes has been fairly stable over the last couple of years. When interest rates really shot up, homes leveled off pretty good. I mean, you've seen some increases, but nothing like we were seeing before. The interesting thing will be, will we see prices of real estate go up? That's the potential. As more and more buyers enter the market with lower rates, then you have the potential for those homes to be worth more as well.
What about for those people that bought in 2023 or, whatever? Are they going to start thinking, hey, is it time for me to refinance? Is that something that's going to become a very popular topic as well?
I think so. I think it just, once again, depends. What I saw, and it wasn't uncommon, right as we were going up through the Fed's raising rates pretty consistently, I saw some high sevens as far as what people were paying on an interest rate. So I think the rule of thumb has always kind of been, if you can get a 1% rate reduction, it's worth the investment to refinance your loan. Of course, there's a cost that comes with refinancing. The banks are going to charge you a fee to do so.
What's that average? Is average 2%?
Honestly, I'm not 100% certain, so I want to be careful. But I think an origination cost on a loan, $1,500 to $2,000, maybe $2,500, depending on where you get your mortgage. But you also have almost always you have an appraisal that has to be involved too,
Right.
and those things run $400 to $600 as well.
Yeah.
So you could be looking $2,000 to $3,000 to refinance a loan, but if you're getting a 1% reduction, you'll make that back pretty quick.
Yeah, it's
So-
just something that's thrown out, I feel like, a ton and I don't think people understand that there's a little more to it than just, hey, bank, you have a better rate, give me it.
Yeah.
I think,
Yeah. No. There's definitely,
Yeah.
and it's not an insignificant cost. It is,
No. Yeah.
it is costly to refinance a mortgage. The other thing people should look at, if you're getting a fairly decent rate reduction, you might look at moving from a 30 to a 15 as well, because 15-year mortgages, the interest rate can be half a point less, approximately. Your monthly payment might go up a little bit because you're paying it off over 15 instead of 30. But usually, if you're getting a somewhat significant rate reduction, you can kind of come pretty close on what your monthly payment's going to be. It's definitely worth looking into. Don't just blindly go in and refinance a 30 back to a 30. You might look at 30 to a 15 as well.
Well, plus, if you're 40 years old and doing that, you're 55 and your house is paid for instead of 70.
Right, absolutely. I know this isn't what we're talking about today, but it's always worth repeating. I see a lot of people that I work with as a real estate agent that are in their 60s, getting ready to look into retirement, buying a new home and taking on a big mortgage, and I cringe when I see it.
We see it all the time.
Yeah. Hard to go through retirement if you're still paying on a house. That's my opinion.
I will say this, going back to my first house I bought in 1974, my taxes are 4 times what I paid for a house payment, taxes, and insurance in 1974. So for some, some people have priced home ownership into their retirement. And do I agree with that? No, but some have.
Well, and we should always say this, every case is different. If you're setting it with a 2.5% interest rate,
Yep.
and you're looking at retirement,
Do not accelerate that payment.
yeah, no kidding. That's
No.
pretty cheap money. So
Well, the other, I remember my mom always said, well, someday you have your house paid off, and then you don't have a house payment anymore. And correct, but we all have house payments, because we all buy insurance on our home, and we all pay taxes.
Yep.
And that's a substantial amount of money today, at least to old people like me.
Yeah.
Well, we've kind of looked at the big picture. Let's shift gears a little bit and focus down on Kansas specific. And we've kind of already talked about the mortgage rates in Kansas. One thing about Kansas, we have a lower cost of living than our neighbors on the coast. If you're on the East Coast or the West Coast, cost of living, specifically when it comes to housing, is pretty significant. I mean, we've caught up a little bit with this big housing bubble that we had over the last several years, but we're still significantly behind them. So a lower interest rate probably impacts Kansans a little bit less than it would somebody who maybe has $1 million home instead of a $250,000 home.
Yeah.
If your mortgage is 3 times the amount, obviously the amount of interest you're paying is significantly more too. So, but it's still huge impact, even if it is less than on the coast, I should say.
Yeah.
Yeah, and one of the things that we'll still have to wait and see is the impact on availability of housing. Right now, we still have, in my opinion, a bit of a bottleneck on housing. I still think there, especially depending on the entry level, or when you look at entry level and maybe mid-level homes, more buyers than what homes are available for the most part.
But are there any spec homes going up?
You don't
in
see very
Kansas?
many. You
Yeah.
don't see many. I'm not saying, there obviously are some, but not like we used to see.
Because that's usually that's all contractor borrowed money, and with interest rates going up, that I figured that dried up.
Yeah, and I still think the way I always understood it, and I should preface this by saying this is kind of my opinion on the subject. It might not be right, but the 2008 housing crash, I think there were a lot of builders that got caught in that, and it was painful. And for those that survived it, they have that memory of what happened, and you see a lot of custom-built homes. You don't see a lot of spec homes. And custom-built homes obviously go up a lot slower, a lot less added inventory due to that, so you don't see a ton of spec homes. And my personal opinion on this is that you still have builders that have that memory of what happened in 2008, and they're just not quite ready to pull the trigger on that, and which is kind of surprising because we've had increased demand on housing for quite some time. So maybe lower rates will drive some of that potentially.
Yeah.
How about I'll turn to you since this is more of your line. How about agriculture and small businesses? What do you think lower rates will mean for ag and small
Well, I
businesses
hope it helps
in
the
Kansas?
farmer. Farmers are suffering this year, and borrowing costs are up. Going to be a great production year from everything we hear from our clients. Prices are terrible, other than in the beef industry. Beef is fantastic right now. Do you know that today we have 73% of live cattle that we had at the start of the pandemic? So there's a note for ag producers: don't have too many cattle. There's a big note there. But
And why is that? Do you know?
well, it's supply and demand.
Okay.
There's less supply, and as I heard this week on Farm Talk, it's hard to pay $19 a pound for a ribeye. You know, it's just hard when you go to the store to do it, but that's where they're at now. And so I kind of got off course there. Cattle are way up, but grain prices are way down. So the other thing is ranchers are feeding their cattle much cheaper
Right.
than, you know, when they're feeding them out at a feedlot. It's less than it was just a year ago. But the whole industry is hurting, and there's a lot of fear that we're going to see another consolidation of the farmer in Kansas, meaning less ag producers being swallowed up by the big ones. I have nothing against corporate farming. Matter of fact, just about every farm nowadays is.
Yep.
But you know what that means is less infrastructure. Our schools get smaller, you know, because the farmer moves off, and you know the same 10 people are farming twice as many acres. So interest rates going down aren't going to hurt the farmer. That's for sure.
Good.
Even though their CD rates might be bad, or their money market, the money they got parked to plant might go down, it's going to be a hopefully good for them.
And I would assume small businesses would be the same. Hopefully, economy picks up a little bit, and if they do need to borrow money, the borrowing cost should be less.
You know, we had a small business that bought his building here in the last couple of weeks. Small business that had just started in less than a year. So there's some small businesses that are doing well, but I'll say in this case, the building he bought was carried by the owner. So, you know, things like that are very attractive because the owner of the property can, let's say, get 5% return, and the buyer gets a much better interest rate and has no closing cost.
Right.
I mean,
Yeah.
So I think we'll see more and more of that as owners of business that are aging out of the business see the opportunity to sell something on time.
So cutting out the middleman, the bank, and or the credit union, which is actually a good segue. How do they do in an economy like this? Does local banks and credit unions, does this help them, hurt them, kind of the same?
I think, if anything, I think it drives people to them. You know, they want to borrow more money. You know, so they want to borrow money for the car that they can now, you know, have a better rate on, or home. So I definitely don't think it hurts them. They might say it, but
How many banks have called you up
yeah.
when you owe money on a business note, a car note, whatever? When interest rates are cut, has a bank ever called either one of you guys up and said, "Hey, interest rates are down, come in and refinance that car"?
Or, hey, your money market's only paying this now.
Yeah.
You know, they might send that in a discreet letter attached to a
Yeah.
statement, but
Yeah.
you know, they're
Yeah.
not calling.
They're
you
not
letting you know.
broadcasting
No.
that they're cutting. Yeah, you know, banks are in business to make money, and they do a fantastic job of that. And they do a great service for all of us.
Very good. Well, let's wrap this episode up. Just kind of big picture for borrowers. You know, if you are borrowing, obviously be careful. That's always a theme of this show, is be careful with your borrowing. But borrowing costs are potentially cheaper. Definitely look to see if refinancing a home mortgage makes sense. That might be an area. If maybe not on this cut, maybe in a couple of cuts down the road. For savers, diversify. If you're you know, heavy into fixed income and you're starting to see your returns, these are the gentlemen you want to talk to. They can help. They've got a strategy for getting in the equities and at low cost. And Bob, what would you tell somebody who's worried that the rising inflation and lower interest rates, what should they do?
You know, we have a lot of clients that are concerned about what are fixed rates doing, and yeah, there's things that like we can buy different types of government bonds. We do not get in the bond market. It's too volatile, and quite honestly, well, wait, the stock market's volatile. Yeah, but we know what it's going to do. Here's the key thing with interest rates dropping, is everybody hears that equities go up. Do not call up your advisor and go, put me in the market. Because that's, you stick with the plan you have. If that's all fixed rate, you stick with that. because interest rates will go back up. Do not call up an advisor and go, I've had you keep $100,000 out of the market. I want you to put it in now. That's, we have a game plan, and we've set up that game plan. Do not change, because those are the people that get caught in that trap of, well, the market's just going to keep going up.
Yeah.
And Mark and I have heard that. We haven't heard get me all in, but we've heard, the market's going to do nothing but go up now. Yeah. I've heard that before, 2008, 1999, 1977. We've all been there. Stick with your plan.
Well, and it's important to note, I'm sure when you put your guys' plans together for your clients, you've got this exact scenario in mind. Maybe not exact, but you've taken into consideration what happens if rates go down.
Yep.
So
Right.
that's part of the plan.
That's part of we've got, somebody in retirement, we have so much of their money on the sidelines in fixed rate, knowing that that's not going to drop. So don't run from fixed rate, especially if you're older. The market gives great opportunities, but make sure that meets your risk tolerance.
Great advice. As we wrap up, just a reminder, and this is a great time to review your financial plan.
Yep.
Review it. Are you on course? And if you need some help with that, bobswartzfinancial.com. The contact information for Bob and Mark is there. They would love to help you. Once again, if you're watching us on YouTube, we'd love you to subscribe, give us a thumbs up. Same thing on wherever you get your podcasts. We'd love to have you join us every week. Until next week, have a great day.
Thank
you.
you.